Look, payment for order flow is just one component of retail interaction with a very complex trading ecosystem. And let me just try to break down retail versus institutional. In our trading system, we've got all sorts of institutional traders. We have all sorts of venues, lit exchanges, dark pools, and we have intermediaries like wholesalers. That interaction among institutional investors, to my view of how to look at this, creates what I would say is a sort of ceiling on execution across the marketplace. Generally, retail investors, the way our market structure works, have been able to come in under that ceiling in terms of execution quality and cost. There have been amazing advances in retail access to our marketplace. Now, I agree with Chair Gensler that we need to continue to look at that in terms of overall effectiveness, that ceiling. Are we continuing to bring it down with technology, data, information, and the like, resilience and fairness? Okay. Payment for order flow is just one component of that, and I think we need to look at it in those terms. And that's the debate you're seeing. Go ahead.
Jay, I guess the question, though, is payment for order flow effectively has allowed the Robinhoods of the world to offer free trading, or what feels like free trading, and instead of you paying an upfront fee for every trade, they're taking a couple pennies potentially on each trade because you're not getting what might be described as the best possible execution. It's effectively just transferring the payment, if you will, via that mechanism as opposed to upfront. The question is, if you would take the payment for order flow piece out of it, do you believe that it changes the model for all of these companies, these brokerages, and changes it in a way that makes less people involved in the market? And is that a good or bad thing?
Really, really good question, Andrew. The question here is execution quality or something else? Are we looking at payment for order flow in terms of whether it enhances execution quality for retail investors across the marketplace? Or are we applying some other criteria, like we don't like gamification, payment for order flow enhances gamification, therefore we need to look at it more closely? Or payment for order flow allows for zero commission trading, which brings more people into the marketplace. So you need to separate the efficiency, the delivery of low-cost trading to retail investors from some of those other policy questions. And we need to look at addressing those other policy questions. Greater access for individuals, or is there too much of an incentive? Are people too juiced to trade? We need to look at those, not just in terms of order type, but other information in the marketplace that helps people make better choices. I think you need to separate those two and be very rigorous in your analysis. And
what does your analysis say about that? Meaning, what would if you were advising Gary Gensler right now, or the SEC or Congress, what would you be telling them?
Do exactly what you're doing. Put the issue out there. Now let's get, and we've done this in the past in this very complex ecosystem, let's get people around the table to discuss this with that rigor. Let's not decide what's good or bad. And I think Chair Gensler has done a very good job of outlining 6 things yesterday that need to be looked at. This was just one of them. Let's, before we make any proposals, before we make any judgments, get people around the table to discuss exactly what you and I were just discussing.
Shepard Smith here. Thanks for watching CNBC on YouTube.